Do you think interest rates will be going up or be going down in 2024? Well, billionaire investor Bill Ackman expects the Fed will cut rates rapidly this year. According to Forbes, the Fed will be slow to cut interest rates this year. According to Bloomberg, the Federal Reserve will lead the charge in cutting rates, with the rest of the world following suit. Recent report from the Motley Fool also agrees the Federal Reserve will be cutting rates in 2024, while others are focusing on hints the Federal Reserve gave at its last meeting about 3 potential rate cuts in 2024. Meanwhile, Morningstar predicts 6 interest rates cuts this year, and all across the board, all we see is headlines of rate cuts and more rate cuts. It seems like, according to most expectations, the only question is how much will the Federal Reserve cut rates by, and how often? But what if I were to tell you that this year, the Federal Reserve will cut interest rates, but the result of that will be that interest rates will actually go higher? And what if I were to tell you that not only is this possible, but it has happened before, and it happened during the exact same situation we are facing today? First, we have to take a look at the federal funds rate. This is a chart of the federal funds rate, which, as you can see, has been on the decline since about 1980. And most people are not aware of this, but the federal funds rate is the only interest rate that the Federal Reserve actually controls. So what is the federal funds rate? The federal funds rate is the interest rate at which depository institutions trade federal funds with each other overnight. When one depository institution has a surplus of balances in its reserve account, it lends to other banks that are in need of larger balances. In other words, a bank with excess cash will lend to another bank that needs that cash. The Federal Reserve sets a tight range at which this lending and borrowing of overnight cash needs can happen. If the market rate starts to get too high because too many banks need cash, the Federal Reserve itself will enter the market and intervene by injecting the cash necessary to cap the rates. If the rate starts going too low because nobody needs cash and everybody maybe needs the collateral, they will intervene yet again to make sure the interest rate doesn't drop too low. What you are left with is the effective federal funds rate, which is going to land somewhere in between their tight range. And like I said before, this is the only interest rate the Federal Reserve actually controls, and it is at the shortest end of the yield curve. It is an overnight interest rate. This is very different than the interest rate on all of the forms of debt that individuals and also most institutions actually care about. This is different than the interest rate on US government debt, treasuries. This is different than the interest rate on mortgages, on auto loans, on credit cards. It can and does have an influence on those interest rates, but the Federal Reserve does not outright control any of those interest rates, only the federal funds rate. So who sets the interest rates on all the forms of debt that people like you and I actually care about? Well, it's actually primarily driven by free market mechanics. Not entirely free. There's certainly a lot of influence and a lot of corruption and a lot of manipulation. But one of the primary driving forces is actually free market mechanics, at least for now. You see, if I'm the bank and you want to buy a car, so you need to borrow $30,000 from me, and you're going to pay me back over the course of the next 5 years, I'm going to take a look at what I think will give me a real return on that money. Because if I just keep the cash and I think inflation is going to run at 3% over the next 5 years, then I'm losing 3% on that cash every single year by not doing anything with it. But if I give it to you and give you a loan for, let's say, 5%, then I'm going to net the difference between the inflation rate and the interest rate I'm giving to you, which is going to be a 2% positive return in real terms. Now, for everybody out there thinking about fractional reserve banking and that they don't actually care about a real return because they're getting some of a return on non-existent money, you're right, we're going to come back to that in a moment. Now, for everybody thinking, hold up, they don't actually have that cash, and so they don't actually care about a real return on that money because they're not holding it. Every dollar they loan, they're just lending into existence, so they're okay taking an interest rate that's below the inflation rate. You're right about that, but let's explain what that means when they're loaning money into existence. If you've never heard of the concept of money being lent into existence before, the source or the origin of new dollars, it can be a little bit difficult to grasp. When I was in college, I was actually terrible with money. Number one, I had a full ride scholarship. Number 2, I worked all through college. And number 3, I graduated with $0 in my bank account and $30,000 debt. Because every single year I took out the max amount I could in student loans, even though I didn't need it. And I spent it all at Chick-fil-A and the gas station on energy drinks and donuts and chips. Yes, I was extremely dumb, and yes, I got very fat in college, but that's not the point of this story. The point of this story is that a lot of the money I spent in college came from student loans. For me to get that cash, an arrangement was made between myself and the lender and my university, and they credited or sent dollars over to my bank account that didn't exist before. When that loan was made, a deposit was made into my account, but it was not transferred to my account from a previously existing source. That loan was dollars being lent into existence. And this is something that banks are allowed to do in the United States because of how fractional reserve banking works. When you make a loan, you're not transferring money from your own account at the bank to somebody else's account. You are lending those dollars into existence. I got those dollars in my bank account and I spent them on junk food. I spent it on gas. I spent it on energy drinks. And every time I made a purchase, those dollars were then transferred out into other accounts, into my room and board payments, to the gas station, to the fast foods bank account. So as a result of that loan, there were now new dollars in circulation in the economy. But it's not all fun and games. Remember, this is debt. It has to be paid back. And I had to go through a lot of struggle, tons of hard work, and a really great system in order to get out of debt, which my wife and I were able to do within 1 year of graduating. This is actually one of the things that I teach members of Heresy Financial University how to do so that you can stop paying interest on massive amounts of debt as quickly as possible and start actually getting ahead on your financial journey, investing and making money for yourself instead of flushing money down the toilet. But if you've ever paid off debt before, one thing you'll notice is you're taking dollars that were in circulation because you get them through a paycheck or through a sale or some money that you earn, and you use that to pay off a loan. Well, guess what? That loan then just ceases to exist. It gets paid off. It goes away. That money doesn't sit in the lender's own bank account. That loan was an asset to the bank, and now that that loan is paid off, the asset disappears. It's gone. And those dollars that were floating around in circulation are no longer in circulation because you got them as income and you use them to pay off debt. So just as money is loaned into existence, when debt is paid down, those dollars cease to exist. Okay, it might seem like we've bounced around a ton. Number 1, we talked about the Federal Reserve is going to lower interest rates, but that's going to cause interest rates to go up. Number 2, we talked about what the federal funds rate is and how the federal funds rate is the lending rate between banks overnight, and it does not directly control any other interest rates. That is set by market forces. Those market forces and expectations about inflation are what push up and down on interest rates for things that you and I care about. And not only that, that debt that we borrow and lend and pay off causes the money supply to expand and contract. So let's put this all together now to understand how this is going to cause interest rates to go up, even if the Fed tries to cut them. When the money supply expands and contracts, it's fairly commonly understood by at least viewers of this channel now that has an impact on prices. All else being equal, if you increase the money supply a lot, that's going to push prices up. All else being equal, if you decrease the money supply a lot, that's going to push prices down. Going back to the federal funds rate, we can see that ever since the 80s, it's been trending down. This is the overnight rate, which has most influence on short-term debt. This is a chart of the 1-year government bond, and you can see the interest rate on this looks very similar to the federal funds rate. Ever since 1980, it's been trending lower, which means that when the federal funds rate goes down, the US government is able to directly borrow at lower rates as long as they're borrowing for a very short-term time period. This is done through a specific type of US government treasury bond called a treasury bill. As of January of 2024, the interest rates are in between 5 and 5.5% on these T-bills. If the federal funds rate goes down to, let's say, 3%, then the T-bill rates will likely be a lot closer to 3% than the 5% that they're at right now. The US government already likes borrowing at the very, very short end of the curve. They love using T-bills to make up a lot of their borrowing. And if that borrowing becomes even cheaper, they're going to like that even more. Right now, the interest on the national debt is a huge concern because it's becoming such a large line item on the overall budget. They're spending over $1 trillion a year just on the interest on the national debt, which means if they are able to borrow at lower rates, this helps with that and increases their ability to spend and borrow without having to worry about the consequences until later. Are you seeing how this starts to play out now? Step number 1, the Federal Reserve cuts interest rates on the federal funds rate. That is the shortest end of the curve, the overnight rate. As a result, it also pushes down interest rates at the short end of the curve, like these T-bill rates. This gives the US government the ability to borrow much more and spend more freely. We know that when debt is created, when money is borrowed, that is dollars being loaned into existence. So as a result of the federal funds rate going down, the government borrows more and spends more. That increases the money supply. And what happens when the money supply increases? Inflation. Prices go up. And if inflation starts to increase again, do you think your lender is going to give you a 3% mortgage? Or do you think it's more likely mortgage rates stay at 6 or 7%? If inflation starts to pick up again, do you think you're going to get an auto loan for 3 or 4%? Or do you think it's likely they stay around 9 or 10%? Do you think your credit card rate is going to go back down to 14%? Or do you think it's going to stay up at 25%? If inflation starts to pick up again, it is more likely than not that all of the interest rates for the type of debt that individuals and institutions care about go up. The only person experiencing cheaper borrowing will be the US government, Uncle Sam. And like I promised in the beginning of this video, we are going to look at a time that this has actually happened before because we understand the mechanics. It's possible. The Fed lowers borrowing rates for the government, so they borrow more, they spend more, that causes inflation to go up, so borrowing rates for everybody else actually go up. This is a chart with a ton of lines on it, so please bear with me, I'll explain what you're looking at here. The blue chart line is the federal funds rate. If you look at the dates at the very bottom, this goes from 1967 through 1982. This was the very last time we had a long-term cycle of prices and interest rates going up. I've talked about this long-term cycle before. That lasted about 40 years, peaked in 1980. The next 40 years was from 1980 to 2020, and that was inflation and interest rates dropping. I believe we've entered into the next phase of this long-term debt cycle that will be similar to 1940 through 1980, with inflation and interest rates both going up again. But right now we're just focusing on 1967 through 1982. The blue chart line is the federal funds rate. This is the interest rate that the Federal Reserve directly controls. The orange chart line that you're seeing here overlaid is the interest rate on the United States 10-year treasury. So when the government borrows a 10-year loan, meaning they have to pay that loan back in 10 years, that's called a 10-year treasury. And this orange line shows the interest rate that the government was paying on those new 10-year bonds during that same time period. The first time period I would like to look at is August of 1969 through September of 1970. During this period of time, you'll see the blue chart line, which is the federal funds rate, dropped significantly, while at the same time, the orange line, the interest rate on the 10-year, actually went up. We can also see from September of 1973 through February of 1974, the blue line, which is the federal funds rate, which the Fed actually controls, dropped. They dropped interest rates. Yet at the same time, the 10-year actually increased in its interest rate. And for the last period of time here, we have July of 1974 through May of 1975. Again, the Federal Reserve drastically cut rates as shown by the blue line going down, that's a federal funds rate, while the orange line, which is the interest rate on the 10-year treasury, again, actually rose. Historically, the 10-year is much more closely tied to things like mortgages and car loans, the things that people care about, than the federal funds rate actually is. This was 3 periods of time during the early 1970s where the Fed cut interest rates, and the result was a reigniting of inflation that caused interest rates like the 10-year to actually go up. We're in a time period right now that is very similar to the 70s, where everybody thinks inflation is dying, inflation is done. We had a little burst of inflation from the money printing that happened in 2020, and that's all over now. Just like they thought during the 70s, which caused them to cut rates, that reignited inflation and resulted in them having to raise rates much higher later on. Very similar time period to what we're facing today. Long-term debt cycle has turned the corner into a new phase, and it is more likely than not that during 2024, when the Federal Reserve cuts interest rates, that will spark a reignition of inflation because the government will be able to borrow and spend so much more. And then the rates on all the other debt that you and I care about will actually go up as a result. And if you're interested in creating a portfolio that is protected from crazy moves like this in interest rates and the results that this will have on other asset classes like the stock market and real estate, join hundreds of other members of Heresy Financial University that are learning to do exactly this. Because in the coming financial storms, there's going to be two types of people. The first group of people are going to lose a ton of money in the volatility, in the crashes, in the buying high, and in the selling low. The other group of people is going to be sophisticated investors who are prepared, who are hedged, and who are ready to take advantage of the opportunities as they come. And nobody wants to be in that first group, but most people will be. So don't be part of the crowd. Sign up for Heresy Financial University, linked in the description below. As always, thank you so much for watching. Have a great day.